Where to invest? Having figured out the reasons to invest, the next obvious question would be, where would one invest? And what are the returns one could expect by investing? When it comes to investing, one has to choose an asset class that suits the individual's risk and return temperament. An asset class is a category of investment with particular risk and return characteristics. The following are some of the popular assets class. 1. Fixed income instruments. 2. Equity. 3. Real estate. 4. Commodities, precious metals.
Metals. Category of investment: fixed income instruments. These are investable instruments with very limited risk to the principal, and the return is paid as an interest to the investor based on the particular fixed income instrument. The interest paid could be quarterly, semi-annual, or annual intervals. At the end of the term of deposit, also known as maturity period, the capital is returned to the investor. Typical fixed income investment includes 1. Fixed deposits offered by banks. 2. Bonds issued by the Government of India. 3. Bonds issued by government-related agencies such as HUDCO, NHAI etc. 4. Bonds issued by corporates. As of June 2014, the typical return from a fixed income instrument varies between 8% and 11%. 2. Category of investment: equity. Equity investment in equities involves buying shares of publicly listed companies. The shares are traded both on the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. When an investor invests in equity, unlike a fixed income instrument, there is no capital guarantee. However, as a trade-off, the returns from equity investment can be extremely attractive. Indian equities have generated returns close to 14%, 15% CAGR, compound annual growth rate, over the past 15 years. Investing in some of the best and well-run Indian companies has yielded over 20% CAGR in the long term. Identifying such investments opportunities requires skill, hard work, and patience. You may also be interested to know that the returns generated over a long-term period were above 365 days, also called long-term capital gain, are completely exempted from personal income tax. This is an added attraction to investing in equities. 3. Category of investment: real estate. Real estate investment involves transacting, buying and selling, commercial and non-commercial land. Typical examples would include transacting in sites, apartments, and commercial buildings. There are 2 sources of income from real estate investments, namely rental income and capital appreciation of the investment amount. The transaction procedure can be quite complex, involving legal verification of documents. The cash outlay in real estate investment is usually quite large. There is no official metric to measure the returns generated by real estate, hence it would be hard to comment on this. 4. Category of investment: commodity bullion. Investments in gold and silver are considered one of the most popular investment avenues. Gold and silver over a long-term period has appreciated in value. Investments in these metals have yielded a CAGR return of approximately 8% over the last 20 years. There are several ways to invest in gold and silver. One can choose to invest in the form of jewelry or exchange-traded funds, ETF. Going back to our initial example of investing the surplus cash, it would be interesting to see how much one would have saved by the end of 20 years, considering he has the option of investing in any one fixed income, equity, or bullion. By investing in fixed income at an average rate of 9% per annum, the corpus would have grown to Rs. 3.3 CRS. 1. By investing in fixed income at an average rate of 9% per annum, the corpus would have grown to Rs. 3.3 CRS. 2. Investing in equities at an average rate of 15% per annum, the corpus would have grown to Rs.5.4 CRS. 3. Investing in bullion at an average rate of 8% per annum, the corpus would have grown to Rs. 3.09 CRS. Clearly, equities tend to give you the best returns, especially when you have a multi-year investment perspective.